Welcome to today's podcast. Thanks for joining me as always. I really appreciate you listening, and hopefully you're getting a lot out of this as you're building your own education and in your financial journey in life. And hopefully it's helping and impacting you in a positive way. And certainly I appreciate you sharing that with others who could benefit. You know, as business owners, and even if you don't have a business owner, you'll get this, but imagine if you're a business owner and you have employees, how many jobs would you want them to do, right? How versatile would you want your staff to be? And, I think most people would want them to do as many jobs as possible, especially if they did them at a high level and to maximize your resources and create some leverage. And, thinking about the same way with our own personal finances, our dollars and our money kind of are like employees. We want them to do as much for us and do as many jobs as they can efficiently so that we can grow and stack our wealth versus doing one job alone. And so that's today's topic today is how do we do that? How do we stack our wealth to accelerate that over a course of time and build on that? And it really takes stepping back from what we are typically taught around building our wealth to put them into buckets and kind of let them marinate there for long periods of time. Don't touch it, right? Because, they tell us we're not disciplined enough to get access to it. So they got to restrict it without penalty. It's our money, but we can't touch it because we're not disciplined enough to do it. And that's a challenge for all of us. And for those who are listening to this, you're probably the opposite. You're owning this, you're learning more, and you want access and control of your wealth to build it and accelerate it as much for you and your family. And so using this concept of stacking is really key. And you can stack over a course of a lot of different layers, but let's just think about how we can potentially do that just on multiple layers, like a few layers. And, typically, so here's how the typical approach works. I, have a house and I'm just, building that up and building some equity. I'm putting money into a brokerage account and it's growing, invested in stocks and bonds or something. And maybe putting some money into some life insurance and that's just growing on the side. So you have all these various buckets and they kind of work in isolation and hopefully they're all going in one direction. Well, what if you could actually use $1 to do maybe 5 to 10 different types of jobs? Well, here's a way that I would suggest thinking about it. And it's not only one, but as a starting point. So for me, and for a lot of the folks that we talk to who are building businesses, investing in alternative assets and kind of broadening what they're doing financially, one of the things they've adopted is leveraging the infinite banking concept and using that as a foundation to store wealth that can be deployed for other purposes. So for those who don't know about this strategy, it's just a way to finance things a little bit more efficiently as opposed to just simply relying on banks. And so in this scenario, you design a whole life insurance policy distinctly to help build cash faster. But as you're doing that, you're not only protecting your family and business along the way, that money inside that policy that's building up can be borrowed against through the life insurance company to be deployed elsewhere. So in that scenario, it's almost like a home equity line of credit where you can borrow against an asset, your cash value, and use the life insurance money for whatever you want. And so that's a way to start stacking. So in that scenario, you're putting money into a policy, it's building up, it's shielded from taxes and growing, very boring, steady, protecting family from death, in some cases disability if you properly design it. And you're borrowing the life insurance company's money to deploy in a secondary asset. Let's just say you're investing in real estate. So the dollars that you've put into your foundational asset of life insurance, a banking policy, is a storage bin. And then you borrow against that. And today it's in the range of 5-6%. And it's, usually can get up to 95% of that, 90-95% of that asset to borrow against and use your policy as collateral. And then you deploy that into anything else you want. So you just use a simple example of $100,000, right? If you had $100,000 in these policies, you can borrow that from the life insurance company, and you pay that back on your own terms. Now take that $100,000 and say deploy it into a piece of real estate that's $500,000, right? So you took your money and now you're deploying that into another asset like real estate that has a whole host of different sort of attributes to it. It can produce income. There's tax benefits, right? You can now get leverage from a bank if you want to funnel that 80% of that cost. And so now you're using another person's money to build another asset that can grow on your behalf, and we can start stacking it. So now you've taken $1 and turned it into maybe 7, 8, 10 jobs at once with the same dollar by stacking them, right? And being creative. And now, obviously, in this scenario, you'd want to be able to make sure that what you're investing in is something that you understand, produces cash flow, is a positive return, right? That is an absolute given, right? Before you do anything like this, you don't use this to go speculate and hope it works out. You're in the world of trying to find investment that you have de-risked and you understand. But this is just one scenario that you can take one asset, turn it into 7 to 10 different jobs of protection, tax benefits, right? Income, equity growth, right? And asset growth, all by using the same dollar and maximizing other people's money to do it. Now, it takes certainly some time and sort of to learn these sorts of things, but it's a very powerful tool. And imagine that piece of real estate now has appreciated on top of everything over time. And so maybe you end up selling that and parlaying that into more assets or businesses and such. So it can really sort of expand your ability to stack these assets and monies over time as you're building it along the way. Now, we kind of talked about the life insurance as one way to sort of start storing cash and sort of leveraging, but you can do that with other assets like your home, like your personal residence that you're building into, you're paying into this debt through the mortgage and hopefully building some equity, but you're building it over time. And there, unfortunately, you won't be able to get all of the equity because the banks are going to protect themselves and maybe give you 70 to 80% if they're generous access to that amount, but then protect themselves a little bit just in case the asset goes down in value. So they're going to give you that. So you can use that home equity line of credit also to invest or use as liquidity as needed. You can use that to stack other places too, right? Buy other rental properties, invest in businesses. Again, you have to be mindful of, though, that you're taking on debt and have to be manageable and responsible for that. And that's why it's so key to know where you're investing in is, investing is always comes with some risk, but spending the time to really de-risk it and make sure that it's going to places that are going to be productive and likely positive. What's that Buffett sort of saying is rule number 1 is don't lose money. And rule number 2 is don't forget about rule number 1. So finding assets that typically will grow and be positive is so key. Another way to go about this too is even in your stock portfolio, right? In your brokerage account, if you have a good nest egg there and you're building that up, they'll loan you, the brokerage homes will loan you a fraction of your asset value, maybe 50%, and you get a margin loan from them to use to invest other places that well and feel positive, or at least likely that it's going to be productive and win, right? And you can use that in the same way, but then they're only going to give you a portion of that in there, and there might be margin calls and things of that nature. So there's definitely a risk to it and something you need to be considering along the way. Where is the control? And so as you go through that, in the life insurance, obviously you have a little bit more control because, you're taking the loans directly from the life insurance company and they have your death benefit as collateral. So there's, you can sort of manage that a little bit closer yourself because those terms, you don't have to pay that back immediately. You have some wiggle room there. But I would highly encourage you make a schedule to pay those back on a regimented basis. The home equity lines of credit, there is always going to be a minimum and interest cost on a monthly basis to pay. And again, they're going to restrict how much they give you access depending on kind of how much equity you have and how much other debt you may already have in your balance sheet because they want to protect themselves as a bank. So there's going to be restrictions on it, mandatory payments to it if you use that home equity line. So you lose a little bit of control. And when you think of it from the stock basis, if you're getting a margin loan, right, they're going to, if those assets go down in value significantly, they're going to want to protect themselves, and you may have to come up with some capital to kind of close that gap. So just know that going in, that there's some risk there, but again, hopefully over time it could balance out, as we've seen over time. Markets are typically, over long periods of time, like going upwards trajectory, but there's always a chance it can come down. So, but overall with these concepts is being smart with using debt to stack it into investments that well, you have some maybe competitive advantage with your knowledge or networks of people that that are controlling these assets. But using other people's money, whether it's the life insurance company or banks or the brokerage houses, like doing that with care and putting in assets that you have a better control over, likely maybe your business and such, that you can sort of influence more, or that kind of the operators who involve or the assets very deeply and feel that they're likely going to win, right? Because there's going to be risk to it. But imagine as that's where it starts amassing over periods of time, that if those are successful, you're going to even have more of those assets to leverage and continue to stack on top of each other. And it can be infinite in that way over time. But hopefully you kind of see the power of that. But I would caution folks to consider over leveraging, right? Because that can get very dangerous quickly, especially if we see downturns in the markets and real estate stocks, and these things can flip very quickly. So you have to do this with care and not overextend yourself, right? At least within, the life insurance side, that asset, if it's properly designed and a whole life policy, that doesn't go down in value. So you won't have a margin call or anything like that to consider, but, and it won't flip upside down unless you stop making payments into your debt, right? Which I would, again, encourage you always to kind of create that schedule to pay that back. But you do have risks when you're using a home equity line of credit, that the house could go down in value, and certainly stock portfolios could go down in value as well. Again, that's why you don't take out all the maximum you can from it and leave yourself cushion and some protection to be able to handle the sort of fluctuations of the economy and performance of investments and such over time. So don't go over leveraging that, because that really could put you in a very dangerous position over time. So this is certainly a much more advanced sort of topic that is not typically taught, because you hear from a Dave Ramsey or others that debt, Susie Orman, like debt is horrible, don't do it. And again, there are cases, I agree, like until you're ready to get into those more advanced sort of situations, I wouldn't, right? And that's why it's there for those who are progressing in their roles and they feel comfortable where they're investing their dollars and have more confidence in where they're going with it and can de-risk it. This can be a hugely beneficial sort of strategy and approach to maximize every dollar that comes into your world, to do more, to have more jobs, to do more tasks for you and your family over long periods of time, to support you to accelerate your wealth building and really help drive you to the success that you're looking for. So I hope this was helpful. There's a lot covered here. Certainly reach out if you ever want to chat about this any further, but getting our dollars to do more than one job and stack the assets over time is really going to give you, a huge leg up and ability to get there faster. And I think that's what probably most people would want to do with their wealth. So thanks again for joining me, and we'll see you on the next episode of the Perennial Pride Podcast.
Thanks for joining me on this episode today. I really am grateful for you as listeners to the Perennial Pride Podcast. I hope you're getting some tremendous value out of it and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help you get more educated around your finances so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life and abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.